So looking at the quarter, we've achieved 598,000 ounces of gold equivalent for the quarter. That's up 21% against the previous quarter, principally because of the Yilgarn South acquisition, and I'll show you some details of that in a moment. That's the main reason for the increase. If you strip that out, we're pretty flat really across the rest of the operations. And I say pretty flat, but it was a good performance from those operations in the last quarter, we believe. There's a lot of confusion in people's minds about all-in costs and all-in sustaining costs, but this is the new metric that we will be reporting going into quarter one. And the good news maybe for some, and maybe it's bad news for others, these are the only metrics that we are going to report in 2014, because it really gives a true reflection of what it costs to produce an ounce in the business. So all-in costs, we've come down to 1,095, and all-in sustainable, if you strip out what we classify as growth capital, and that's really at South Deep, that's come down to 1,054. Net cash generated from the core business before financing and any acquisitions, $38 million. That has been a key consideration for us, is to turn this business back to cash positive in the face of an unprecedented decline in the gold price during the course of 2013. And it's a start to where we want to get to, but importantly, it's a big turnaround from where we've come from. Normalized earnings of $14 million. We've paid a dividend in line with our policy, and let me just confirm again, our policy has not changed. Our policy is still 25 to 35% of earnings that we'll use as a basis for dividend payout. We're paying 22 cents, and that comes to around about 30% of normalized earnings for the quarter. We strip out the non-recurring items for that basis. As we flagged back in August when we presented here, we would be doing some impairments at year end. We had to run all of our economic models at $1,300 per ounce to do that. That took us a number of months because we had to rerun our reserves. And so that means that we're impairing around about $672 million at year end. What you're seeing really over the last 2 quarters in particular is we've managed to increase the production base with the Yilgarn South acquisition. But at the same time, we've dropped the cost base, the all-in costs in red. We've dropped that down very significantly over the same period. And I think that sets Gold Fields up to be much more sustainable at the current price levels. And we're not restructuring this business hoping that the gold price is going to recover. We're restructuring the business expecting that 1,300 is what we have to work with for the foreseeable future. In the longer term, I think it will improve, but we have to accept that over the next year or so, this may be as good as it gets. So looking at the $450 million I talked about, removing that from the cost base, how have we managed to do that? There's no real silver bullet as such. It's a range of initiatives. It's cutting out marginal production. We've said previously it's not about ounces, it's about cash. So we already started cutting down marginal production in 2012 as we sought to improve the margin per ounce. That's when we shut down the St. Ives heap leach operations. We pulled out of the low-grade Agnew areas, and we shut down the Tarkwa South heap leach. We've also trimmed our corporate and regional cost structures. We've had a 10% reduction in headcount over that period, which including contractors translates to around about 1,700 or 1,800 people. We've rationalized our capital. In 2012, we spent $1.2 billion. This last year past, 2013, we spent $739, and that figure will be lower again in 2014. Now you might say, well, what are we giving away in terms of the future? And the one thing we haven't stopped is development and stripping our pits to make sure that the future plans of the company are not compromised. I lived through $250 gold in 1999, and I saw what we and what the industry did. We pulled back our development significantly, and we never really got it back. We said that we did, but we actually never got it back, and we paid the price. So the important thing is, let's make sure that we retain the structural integrity of our operations. So that's the expenditure, or what I call the good cost, that we're going to continue spending. We certainly got work to do on labour productivity. That's a key focus in this country. But I think the grassroots training of people, school education, tertiary education, we need to put more effort into that as a country, and that will help us to improve the skills. And I think there are a lot of programs underway to do exactly that. But it takes time. You don't see the benefits immediately. But I think over time we will.